Hey everybody, Rob Maurer here, and today we are going to be going through Tesla's Q1 earnings report. We should get the shareholder letter in about 10 minutes or so, so if you are joining this after the live stream, make sure to check in the timestamps in the description to kind of fast forward to when we do actually get the letter. Before then, we've got some things to talk about. We'll take a look at Tesla's price changes that happened late last night in the United States, and talk about a couple of things as we head into earnings. So as I turn on the live stream here, unfortunately Tesla is dropping a little bit as we head into the close. Dropped about $3 over the last 10 minutes or so, and I'm not sure exactly what's going on. I haven't been closely following the news for the last specifically 10 minutes. I'm not sure if there's anything that's broken, so if there is, just let me know in the description or in the comments or live chat. The other thing to say is that after this, we will have the Q1 earnings call, so that'll be at 4:30 Central Time. There will be a link to that down in the description as well, and then the live stream after this ends should carry you over to that. So we'll listen to the call together, I'll take notes, and then we'll do a reaction after we get the call. All right, so looking at that, I'm just gonna keep a close eye here on the chat, just reorganizing things a little bit so I can look at that. And we'll just see if Elon's tweeting anything. Doesn't look like anything new in that regard, so we'll just kind of keep an eye on things. But first, let's go through the price changes and see what happened in the United States in terms of pricing last night. So let me flip over here to Excel. Give me 1 second on that. And we can see the updated price change table here. So the big changes for the Model Y, $3,000 price cuts on all versions. So the quote-unquote standard range, the 4680 Model Y, and now starting at $46,990. When you add the $7,500 federal tax credit on top of that, of course, that would bring the price below $40,000 at $39,490. So probably the best deal that there's ever been on Model Y, especially considering inflation. If we do consider, though, where Model Y used to be priced, obviously this is a different vehicle at the time. I believe the standard range that Tesla briefly introduced and then taken out of the design studio, that was a rear-wheel drive version, but there was a time when that did start at, $41,990. But again, that was very short-lived for Tesla when that was introduced. Of course, we do see this, standard range Model Y over in China as well. But all that said, it's a very compelling price right now for the Model Y with that tax credit. Then the long range, that's now below $50,000 without the credit, and then the performance also cut $3,000 now at just under $54,000. So you can see the price changes there for the long range. This is now in line with the starting price in 2021. So it's been, as high as, I think, $16,000 above that at the peak. And now that, of course, has returned to those levels. But Model Y production, a lot higher now. So, I hate to say, continue to expect price cuts going forward. Obviously, consumers are going to be keeping their eye on those things. But just based on the historicals compared to production, it wouldn't be shocking to see that kind of a thing continue. As Tesla obviously ramps up Giga Texas, brings on more production. With the introduction of the 4680 Model Y into the design studio, that's obviously going to take some orders away from the long range, so they're going to then need to compensate with some price cuts to make that happen. And then obviously you've got the tax benefit, tax credit working in Tesla's favor on those orders. So you can see the changes there since 2022, down 15, down 16%, hopefully costs decline. Maybe not to quite that level, but at least directionally as materials come down and as production ramps. As for the Model 3, that now starts at $39,990. So with the credit, that is going to be right around $36,000. Of course, the rear-wheel drive credit got cut in half, so not super surprising to see Tesla now have reduced the price since that happened by first $1,000 right before it, and now a couple $1,000s after. So getting close to making up that difference from the price, including the tax credit prior to the adjustment in terms of the halving of the tax credit eligibility for the rear-wheel drive Model 3. Still, though, $2,000 higher starting price than it was at the start of 2021. So again, similar situation there as we go along. Wouldn't be terribly surprised if those continue to come down. And that's okay. We'll get a look into how that looks for Tesla's margin today to get a better understanding of how that's going to influence the rest of the year in terms of the financials. For the Model S and X, kind of interesting, no price cut there yet. We've talked about those. It seemed like it was a little bit tougher of a quarter in the first quarter based on the delivery numbers compared to production. Obviously, I think a 9,000 vehicle spread there, but some of those vehicles in transit too, so a little bit difficult to say. With these not being eligible for the tax credit, though, effectively for for customers that are eligible for that tax credit, it does widen the gap between a Model 3 and a Model Y, or a Model S and a Model X. And there definitely are people that are in that boat kind of comparing those vehicles, so it just makes it a little bit more difficult to go up. So with the inventory potentially building on those, again, wouldn't be surprised to see the S and the X cut. Actually, a little bit surprised to not see them alongside the 3 and the Y here. All right, so we got about 3 minutes left. I do want to flip over quick to the forecast that we went through yesterday. Hopefully this is all set up correctly. I was just kind of playing around with things. I think it's all good. So once we get the actuals, we'll come in here and fill these out. Always the best part of the earnings day, watching me fill the spreadsheet out. But try to get that in there so we can have a little bit easier context for what Tesla reports. One thing to keep an eye on, though, as we had talked about yesterday, in the analyst compiled consensus, we didn't get a breakout for regulatory credit, so it looks like that might be a little bit of a foreshadow for Tesla maybe no longer reporting that specifically in that way, which could make some of these calculations, particularly automotive gross margin, excluding credits, down here, which is one of the first things we normally look at. We may not be able to get that calculation this time around. And there's maybe even potential that Tesla would, they said last quarter that they're going to stop focusing on sort of automotive profit or gross margins and really just focus on operating margins. So there may be potential that, Tesla could no longer break out these buckets between automotive, energy, and services and others. I'm not sure exactly what the requirements would be in terms of the business segment size where Tesla would have to report it. If anyone has, more insight on that, definitely welcome that in the chat or the comments today. But it looks like we could be in for some reporting changes. So as we see what Tesla does report, we'll have to keep an eye on that and see how that affects how our recaps look. That could also affect the average selling price calculation, because historicals that I've got here, that excludes regulatory credits. So if that's no longer a broken out item, then we would have to adjust that to be inclusive of it, which obviously is probably not the best gauge for the actual selling price of the vehicles. So it'll be interesting. There may be some things that we kind of have to work through with this report as Tesla maybe tries to bring it up a little bit. And one of the things I could think of with that is that Tesla wants to reduce the focus on automotive margins potentially as they are cutting prices. The other possibility is that Tesla wants to reduce the focus on regulatory credits. As with the Inflation Reduction Act, there are now going to be credits that Tesla is potentially generating for battery production and battery assembly. And as they do that, that's going to come into the financials. We don't really know exactly where that's going to be reported at, but that might be another reason that Tesla is reevaluating how the reporting structure is, if they are. We don't know that for sure. It's just, again, kind of what seems to have been foreshadowed a little bit yesterday. So, we'll keep an eye on that. But for now, let's go back to, I want to take a quick look on that note at something that Zach said on the last call. So let me flip back to the browser here. And unfortunately, I just lost the place. So in terms of those battery production credits, Zach was asked about this on the last call, and he said, we think that it's going to be on the order of 150 million to 250 million per quarter. So in the estimates that I had that we walked through yesterday, I don't really have that broken out specifically. I'm kind of just leaving that as a potential cushion because I don't have a good understanding of how that's going to be reported, what the timing for recognition of those things is going to be. So I'm kind of just waiting to see what information we get from Tesla on that. But that could provide some upside, maybe 5-10 cents or so, probably closer to 5 cents in terms of earnings per share above what my forecast is. But obviously that's pretty close to a margin of error. All right, so we are now at market close. Let's see where the stock ended up here, and I doubt we've got the report quite yet, but we'll refresh on that as well. Usually it takes 5 or 10 minutes to get into market. I usually have people in the chat trolling me and saying it's out when it's not, so I guess you can do that if you want, but I would hope you guys want to be nice to me and actually help me, because it's kind of hard sometimes to get a view. Sometimes I see it first on the Tesla Twitter feed. Usually we can kind of get a gauge for when it's out from the after hours movement, which we don't have any yet. So in the meantime, hey, like the stream. I do appreciate that. I think we've got, we've got 5,000 people here and 300 likes. So those ratios are not in my favor sometimes. So I do appreciate that, but we can go back maybe and just kind of go through the forecast that we had talked about yesterday. I do just want to make sure that we're staying cognizant here as don't necessarily know exactly when it's going to come out. But it's also not the most exciting thing to sit here and watch me refresh. So if you are just tuning in, again, we're still waiting for the letter. After this, we will have the earnings call, and the link for that will be down in the description. So I'll do my usual setup there where we kind of take notes as Tesla does the call, and then talk about it afterwards. So just make sure to tune in for that at 4:30 Central Time, so about an hour and a half from now. Wow, that asking for likes actually worked. Now we've got 1,200. I don't like to do that every day because it's annoying, but if you guys can just assume that I said that every day, that would be awesome. We got Ross over there on Yahoo Finance. Got some Elon gifs. So I don't think we've got anything yet, but if anyone has any questions, feel free to throw those on there. Oh, stock's up a little bit after hours. So first thing we do when we get the letter is just we'll go through kind of Tesla's comments, which we've got it right now. And then we'll take a look at the financials. And with the stock being up, let's hope that means some good news. It's up about 1% as we open up the letter here. All right, so 11.4% operating margin. So I already know that's within 10 basis points of my forecast. GAAP net income, I believe, is also right on. So earnings per share should be pretty close. We'll come back to read the letter as we get the rest of it. But yeah, so I think analyst consensus actually dead on. I think I was a penny short of the EPS. So hopefully that's good. In terms of, I think, people probably having some concerns as we go into this report that it could be a huge miss. But this hopefully means that Tesla still has pretty decent profit margins despite those price cuts. Obviously, this is going to be down year over year, but hopefully this can help us establish kind of a new base that we build from here. So let's see, we do have a breakout for revenues. We've got total revenues. I just want to kind of get a sense of, what might have changed here. I don't see regulatory credits right off the bat. Okay, so huge negative impact from foreign exchange. And again, we'll come back to these. I'm just trying to get a sense of what might be different in the reporting. Cybertruck and tooling. Not sure if that's different. All right, so we'll head back to the top after we kind of just level set with the financials, relatively in line with expectations. Obviously, there's tons of things under the covers that can cause changes there from what we, forecast. But let's just read the summary here. So in the current macroeconomic environment, we see this year as a unique opportunity for Tesla. As many car makers are working through challenges with the unit economics of their EV programs, we aim to leverage our position as a cost leader. We are focused on rapidly growing production, investments in autonomy and vehicle software, and remaining on track with our growth investments. Our near-term pricing strategy considers a long-term view on per-vehicle profitability, given the potential lifetime value of a Tesla vehicle through autonomy, supercharging, connectivity, and service. We expect that our product pricing will continue to evolve upwards or downwards, depending on a number of factors. Although we implemented price reductions on many vehicles across regions in the first quarter, our operating margins reduced at a manageable rate. We expect ongoing cost reduction of our vehicles, including improved production efficiency at our newest factories and lower logistics costs, and remain focused on operating leverage as we scale. All right, so basically so far just saying, hey, it's a unique period of time right now. Tesla's going to continue to drive unit economics as they always have, and not worry too much about the specific margins on the vehicles at this point in time, as there is opportunity on each of these cars to earn money later on in the future. And of course, as they generate scale, if the market returns to a more favorable position, Tesla's got that scale ready to go to take advantage of that. All right, so we are rapidly growing energy storage production capacity at our mega factory in Lathrop, and we recently announced a mega factory in Shanghai. We are also continuing to execute on our product roadmap, including Cybertruck, our next generation vehicle platform, autonomy, and other AI-enabled products. Our balance sheet and net income enable us to continue to make these capital expenditures in line with our future growth. In this environment, we believe it makes sense to push forward to ensure we lay a proper foundation for the best possible future. So I like that summary a lot. I think it does a good job of summarizing a lot of the things that we've been talking about, about this period of time and about Tesla's strategy in a pretty clear and hopefully understandable way for investors. That doesn't mean that it's not a difficult period. It is more difficult certainly than what Tesla's been facing for 12 months, although as I say that, there's been a lot of challenges during that period of time too with everything COVID related, but it's a uniquely different situation now. All right, so profitability, we kind of covered that. Cash, operating cash flow of $2.5 billion, so that's great. Free cash flow, $0.4 billion, 0.2 increase in cash and investments in Q1. Cybertruck factory tooling is on track, producing alpha versions. So I'm not sure, we'd heard production beta, so I don't know if that's different. I don't know, we'll have to hear from Tesla on the call on that. Model Y, the best-selling vehicle in Europe in Q1, and Model Y, the best-selling vehicle in the US in Q1. So on track to potentially be the best-selling vehicle in the world. Obviously, we're missing Asia in that update, but hopefully, if Tesla can track to be the best in both of those markets, that would put Tesla in contention for that, or the Model Y in contention for that later on this year. All right, so right off the bat, automotive revenue is coming in a little bit lower, I notice, than what I had expected. Energy, generation, and storage coming in higher. Services and others coming in higher, putting total revenues pretty much in line with my expectations. Gross profit, again, pretty close as well. Operating expenses, I think, are a little bit lighter than I had forecast. And then, EBITDA and the rest of the bottom line stuff should be pretty much in line, since we know EPS was in line. So capital expenditures, you can see Tesla still continuing to spend. They've been at the $1.8 billion level for kind of the last 4 quarters, now moving that up even in this challenging environment to $2.1 billion. So significant capital expenditures, Tesla continuing to execute on their growth plan. Maybe this ticking up now a little bit because of Cybertruck. Probably not anything significant there for Giga Mexico quite yet. So that would be my best guess, in addition to things like, continuing to grow 4680 production, continuing to expand energy, things like that. All right, so financial summary. Revenue grew 24% year over year to $23.3 billion, which is that should be an all-time high. Nope, okay. It's comparing to auto revenue. So a little bit lower sequentially, about $1 billion decline, but this would be the second highest revenue quarter for Tesla then, historically. So they say that revenue growth was driven by growth in vehicle deliveries, growth in other parts of the business, reduced average selling price year over year, excluding the foreign exchange impact, and negative foreign exchange impact of $0.8 billion. So as I had talked about yesterday, that's just something I don't have a really good handle on estimating, and that's probably what's driving the automotive revenue down there versus my forecast. And I think if you exclude that, it's probably the ASP would have even come in a little bit higher than my expectation. And then obviously that would flow through the rest of the financials, which would also drive things higher than my expectations. Now, that being said, you can see here, we don't see regulatory credits broken out unless I'm, missing that later in the report. So those could have been high this quarter to kind of help show stronger margins. And if those aren't things that can be repeated going forward, we could see, a little bit of a drop. And as I say that, I read through profitability and we see lower credit revenue. So that's actually a really good thing to me. I think that, last quarter wasn't too high. I think it was in the $400 million range. So if we're seeing these results without a huge boost from regulatory credit revenue, that means that this would be something that is more sustainable going forward. And as Tesla continues to cut prices, as we have seen this quarter, they do have room to work with, especially as costs hopefully come down pretty significantly, as foreign exchange impact potentially reduces, and as production scales. So I think that's, to me, that's a really positive sign. It's just kind of strange that Tesla stopped reporting that. All right, so after hours, we're now down 1.4%. Kind of interesting reaction. Maybe there's some other things in here that are being taken as a little bit more negative, but so far I'm pretty happy with what I'm seeing. Nothing, no huge red flags, I don't think, that we weren't anticipating. Growth in vehicle deliveries. So despite margin headwind from underutilization of new factories. So we talked about that. Berlin and Texas, even last quarter, hitting those significant production milestones, still basically like 25-30% of their production capacity. So tons of room to grow on that. And that's going to significantly drive costs down. Gross profit growth in energy business. So that's really good to see. Hopefully we'll get that breakdown a little bit later in the financials. Reduced ASP, higher raw material, commodity, logistics, and warranty costs. So that's an interesting item because I think people have been expecting that to come down. And I think that's actually a positive thing because these are things that are sort of outside of Tesla's control, not 100%, but a portion of those costs are outside of Tesla's control. Maybe excluding warranty there a little bit. But if we think about those things, Obviously, we've seen spot prices on a lot of raw materials come down. Logistics, this should be something that improves for Tesla over time as Texas and Berlin ramp. So a lot of these things can come down later on, which can support further price reductions like what we're probably likely to see. All right, and then cash, we talked a little bit about. Cash increased sequentially by 2.2 billion, 200 million, so 0.2 billion. So 22.4 billion in Q1, mainly driven by free cash flow. So they did repay a little bit more debt this quarter, even though that is obviously quite low. All right, so operational summary, shouldn't be any surprises here. We already got the production and delivery numbers, no change on the delivery numbers. Previously, we had seen Tesla adjust those a little bit, maybe by 0.5% or so, but no change there. Days of inventory, so we had previously calculated this, and right around 15. I think we may have calculated 16 just based on, we're rounding to integers here, so we don't necessarily know the exact vehicle count that we're building off of, but 15, not actually a huge increase quarter over quarter, despite production outpacing deliveries by 18,000 vehicles. All right, and then solar and storage. So probably one of the most exciting parts of this report, 3.9 gigawatt hours of storage deployed. So I had 3.5 in there. I lowered it to 3.1. Analyst consensus was about 2.1 if I recall correctly. We'll take a look at that. But 3.9 gigawatt hours, that's super exciting. Annualized over 15 gigawatt hours a year run rate in this first quarter. So exciting to see that, and hopefully that continues to ramp alongside Lathrop. I did just get a super chat saying regulatory credits down 500, or regulatory credits were $521 million. So this must be talking year over year, which I should have put together. So thanks for that super chat. Appreciate that. Appreciate that, Alan. And last year, as we talked about, it was like 637 million. So 521 million this quarter. Still a significant number, up a little bit sequentially, a little bit higher than what I maybe would have hoped to see, higher than my forecast for sure. Obviously, though, some of that being offset by the by the foreign exchange impact. So, those two things in combination, you're still washing out negative from the impact of foreign exchange. All right, so energy, really good. Obviously, a little bit of a drop there in solar. Sometimes that can happen in Q1. It's, unsurprisingly, probably a little bit seasonal on the solar installs. Tesla locations, mobile service fleet, continuing to see growth there. Same thing with supercharger and service, or supercharger locations. All right, so I do want to just really quickly pull up the last report. It's always kind of good to take a look at how this production capacity chart changes. So we're looking at the Q4 report here right now. I'll try to put that in the same spot and try to make sure I'm not covering that, as I sometimes tend to do. All right, so Q1, Q4. They look similar, except Berlin has now expanded to a greater than 350 production capacity listed. And that was greater than 250,000 before. So with the run rate, we know Berlin hit the 5,000 vehicle per week number. Tesla telling us right now that the capacity that is currently installed is higher than that, which isn't too surprising. Obviously when we look at numbers from Shanghai, Tesla has a number of different months at 80,000, which is annualizing more towards the million mark. So they're significantly understating Shanghai. And I think probably the same thing with Berlin and Texas too. I think we know that the scale for those is kind of intended to eventually be about 500,000 per year. But still, nice to see a little bit of an increase there. In terms of the status, I don't know if we've got any changes there. I don't think so. So those all seem to be the same. So let me make sure I close the correct report. And we'll read through what they've got to say here. So in Q1, we produced a record number of vehicles thanks to ongoing ramps at our factories in Austin and Berlin. Remain committed to reducing the percentage of vehicles delivered in the third month and smoothing deliveries throughout the quarter, which will help reduce cost per vehicle while increasing in-transit inventory at the end of the quarter. So still unwinding the wave. Model Y was the best-selling non-pickup vehicle in the US in Q1. We showcased 4680 cell production at our 2023 Investor Day. Production rate continued to improve sequentially in Q1, which no surprise given the introduction of the 4680 Model Y to the design studio. And then equipment installation for Cybertruck production at Giga Texas continued in Q1 and remains on track. So a lot of people will be happy to see that, I'm sure. Shanghai, since our Shanghai factory has been successfully running near full capacity for several months, we do not expect meaningful increase of weekly production run rate. We launched sales in Thailand, a new market supplied out of Shanghai. Thus far, the reception has been very positive. Giga Shanghai remains our main export port, or our main export hub. So nothing too crazy there. You can see market share continuing to rise. Started to flatline a little bit there in China, but ticking up as we've seen those price cuts take effect. All right, and then for Europe, production line in Germany produced over 5,000 vehicles in a week towards the end of Q1. In Q1 2023, Model Y became the best-selling vehicle of any kind in Europe, EU, EFTA, and the UK. So awesome milestone. Core technology, autopilot and full self-driving, continuing to see the increase in cumulative miles driven with FSD beta. So continuing up and to the right, obviously highway miles now being introduced. That's going to hopefully even accelerate that even further for the second quarter as more vehicles now have version 11. Not sure exactly when that cutoff would have been for the end of the first quarter. Have to go back and see on that, but Tesla says the growing fleet of FSD beta users has an exponential impact on total FSD beta miles driven, with over 150 million miles to date and counting. This level of data collection is unprecedented in the industry. Mass collection of diverse data sets is essential for AI-based approach, the only approach we believe can work for scalable autonomy. In Q1, we enabled the latest FSD beta software stack for highway driving. Vehicle and other software. While our various vehicles provide different range, acceleration, or vehicle size, we believe the Tesla software experience is the best in class across all vehicles. Given the base Model 3 offers seamless integration of vehicle controls, safety and security features, and a full suite of connectivity and entertainment features, and ongoing software updates bring yet more functionality over time. Recently, we launched homegrown recruitment and employee health and safety platforms as part of the broader Tesla OS ecosystem. More details on page 12. And then it looks like we've got just a recap of a slide that we had seen at Investor Day of just the structural cost declines on the Model 3 since really they started to hit volume production back in 2018. So we've talked about that previously, which I believe this is probably kind of a recap of that as well, talking about the 48 volt transition to with the Cybertruck. So stuff that we've talked about from Investor Day. Cost reduction remains the main enabler of delivering on our mission. All right, other highlights, starting off right there with the energy storage. It's awesome to see. And Tesla says, of course, they improved profitability too. So energy storage employment increased 360% year over year in Q1 to 3.9 gigawatt hours, the highest level of deployments we have achieved due to ongoing megafactory ramp. The ramp of our 40 gigawatt hour megapack factory in Lathrop, California has been successful with still more room to reach full capacity. This megapack factory will be the first of many. So not just two, many. We recently announced our second 40 gigawatt hour megafactory, this time in Shanghai, with construction starting later this year. Solar deployments increased 40% year over year to 67 megawatts, but declined sequentially in the quarter, predominantly due to volatile weather and other factors, so seasonality mainly. In addition, the solar industry has been impacted by supply chain challenges. All right, and then services and others. So it looks like gross margin improved there. Both revenue and gross profit from services and others reached an all-time high in the first quarter of 2023 within this business division. Growth of used vehicle sales remained strong year over year and had healthy margins. Supercharging, while still a relatively small part of the business, continued to grow as we gradually open up the network to non-Tesla vehicles. So interesting to see that. As we walked through, I'd expected that to decline sequentially because Tesla did have, because Tesla did previously talk about how used car sales were helping to drive profitability for this segment. So with average selling price pressure on new vehicles, I had expected that to impact the used vehicles that Tesla was using to help drive profit from that. Sorry, I'm just trying to make sure everything's still good here, which it looks like it is. But I would expect that, so it's interesting to see that continue to increase. Maybe that means that non-warranty service work is making up a bigger portion of that profitability in that segment. Maybe Tesla will give us some hints on that in the call. All right, and then outlook. So maybe this has something to do with it. We probably should have looked at this a little bit earlier, but okay. We're planning to grow production as quickly as possible in alignment with the 50% compound annual growth rate target we began guiding to in early 2021. In some years, we may grow faster, and some we may grow slower, depending on a number of factors. For 2023, we expect to remain ahead of the long-term 50% CAGR with around 1.8 million cars for the year. All right, so that seems fine. no change really in guidance. Obviously, Tesla talked about internal targets being a little bit higher, so maybe some perception of that declining, but the official guidance Tesla gave is reiterated here. So doesn't seem to be any major change there in the outlook, which I think should be seen as a positive, given that there was some expectation forming that maybe that would be reduced. Cash, sufficient liquidity, kind of what we hear from Tesla every quarter. Profit. While we continue to execute on innovations to reduce the cost of manufacturing and operations over time, we expect our hardware-related profits to be accompanied with an acceleration of software-related profits. We continue to believe that our operating margin will remain among the healthiest, or among the highest in the industry. And then for products, Cybertruck remains on track to begin production later this year at Giga Texas. In addition, we continue to make progress on our next generation platform. All right, so nothing too bad in the outlook there. That's kind of surprising. Again, reading through this, I'm not seeing anything that's, sticks out as being overly negative relative to sort of what consensus expectations were. And with that being the case, it should highlight that even with all these price cuts, Tesla's still operating in a position of strength relative to the rest of the industry. All right, so Tesla operating system, I assume this is page 12. Yep, so they talked a bit about more information on this. So talking about how they've done a lot of their enterprise software in-house, which we've known about, maybe getting a little bit more information here than we've previously seen. But really just walking through that full vertical integration, kind of, end-to-end supply chain of services. So the impact eliminates need for expensive third-party software, ability to scale product and headcount growth without excessive incremental cost, exceptionally low lead time and improved agility in decision-making, and ability to effectively manage information security risks, customer data, and experiences. So probably something that's underrated in terms of, Tesla's competitive position. As they say there, provides a lot of advantages for them that other people probably don't have. All right, Cybertruck production line. That is exciting to see. I'm just taking these in. I don't have any comments. We're getting close though. As we've talked about, a lot of the hiring now commencing for the Cybertruck production line. I like that photo. I'm in the Midwest, so I hope to have an opportunity someday to do some of this winter testing myself. But looks pretty cool. I'm trying to see if there's any differences we can see. I think that's probably just like still got that upper part there, but interesting. Looks pretty cool though. All right, Megapack line. We've already seen some photos of that. 4680 cell production. I mean, hopefully this stuff gets people excited about what's going on, right? Like, these things are all still very early stage in the impact that they're going to have. In the case of the Cybertruck, non-existent right now in terms of hitting the financials, other than probably hitting the cost a little bit. And then Megapack, very, very early on in the ramp. Again, I remind people for probably the 10th time since Investor Day, go back and look at that chart. Even though we're seeing this exponential growth in energy storage right here, like this is already an amazing growth curve, up 360% year over year. Even though we're seeing this right now, this is the early stage. So that is only going to continue, which is, extremely, extremely exciting for where that business can go. It seems like it's finally happening, the energy storage business line becoming significant. All right, so there's some of the financial metrics put into charts. All right, so operating margins. Interesting that Tesla's got the S&P 500 on there. So they'll have to come back and update this as we do get more reporting for earnings over the next couple of weeks. But it shows that this has already been on a bit of a decline. And if that, kind of continues, then hopefully that puts some good context around what Tesla is seeing. Same thing with the auto industry. That'll be interesting to keep an eye on. Looks like it's held up pretty decently so far. I think that's probably a result of the inventory constraints that were being experienced during this period of time, where margins kind of increased. But certainly now that those situations seem to be flipping a little bit, I would expect these to kind of return back to the sort of normal position that they had and, maybe continue on in that way. So this will be one of the most interesting charts to follow over the next 12 months. right, and then we get into the financials. So regulatory credit revenue right there. Yep, all right. So I hope that's good. We can kind of hopefully get to all the financials that we need from that perspective. All right, and then we'll look through how these fit into the sheet. I think we kind of already have a pretty good idea of that, but we'll flip over and fill some stuff out here. Again, reminder, the earnings call is in about an hour. There will be a separate live stream for that on this channel, and the link for that is down in the description. All right. I'm gonna flip over now to Excel, and we get into the exciting spreadsheet fill out portion of the episode. Okay. All right, so energy storage. I'm just gonna kind of flip back and forth here. So it'll take me a minute. But for energy storage deployed, we've got 3889 there and 67 there. So I was 20% too low on my forecast. Analyst 41% too low. They were at 2.3 gigawatt hours, actually expecting a decline quarter over quarter. And Tesla blowing that out of the water. Again, that 360% year over year growth. Extremely impressive for the energy storage business. Automotive sales. Give me a second to find that. Should be at 19,963. So up 18% year over year with, of course, deliveries up 36%. And my forecast was 1% higher than the actual here. But of course, with the $521 million of regulatory credits, we're looking at probably a $500 million difference there. Though obviously with an $800 million impact from foreign exchange, if you sort of exclude that, looks like the average selling price X foreign exchange may be a little bit higher than what I was expecting. So it's in the ballpark, and it's good that Tesla has these regulatory credits available to, kind of help offset those the last couple of quarters, because that has been a significant negative driver for these last 2 quarters. All right, so energy sales, I don't think I've actually seen this number yet, so let's see what this is. Could be an exciting one, and particularly the profit I'm curious about. Okay, so energy storage, 1529. So 148% growth year over year, with obviously deployments up 360%. So average selling price is declining there. My forecast was 8% too low. Analysts forecast 21% too low. And then for services and others, we'll take a look at energy profit in a second. But service and others was 1837. So I was 3% too low with my forecast on that. Analysts 7% too low. So as you can see there, revenue I was within, about 100 million. Same with analysts, kind of split the difference right in the middle there on total sales. But obviously a little bit higher on energy and services, and a little bit lower on automotive. All right, so we'll have to come back to the ASP. I'll calculate that at the end because that'll take me just a second to do. So we'll kind of continue on here. Automotive profit should be our 19,963. And cost came in for automotive at 15,755. So we should be at 4208 there. So I was a little bit 4% too high on my forecast. And again, we don't get that analyst breakdown. Energy profit, we should be at 1529 minus the cost of 1361. So we should be at 168 there. So it looks like the margins on energy actually a little bit lower than what I had forecast, which I'm not going to say is disappointing, but given that the revenue was a little bit higher, the deployment's a little bit higher, I would have hoped for that to be higher. Not that that's a bad thing at all. It's still a very healthy margin for Tesla at this stage as they continue to ramp. Again, Lathrop only probably a third of production capacity right now. But just eagerly, I would say I would have wished that would be a little bit higher, but certainly not a problem. And then for service and others, we've got 1837 in revenues and the costs of 1702. So we've got $135 million profit there from services. So 17.3. So let me just double check this total gross profit number. I'd miscalculated that last quarter, so don't want to make that mistake again, but 45.11, right on track. So I was $80 million too high in my forecast. Analysts, $250, $280 million too high. All right, so here we can see the automotive gross margin comparisons. So X credit, again, this is one of the ones that is most interesting, 19%. So it's a little bit lower than the 20% that was asked in that question. This would be inclusive of leasing. So when you exclude leasing, this would actually even be a little bit lower, probably in the 18% range, maybe 18.2, just kind of roughly guessing that. So it does seem to be a little bit lower than what was stated from that question last time, but as Zach said, there is uncertainty. There is, and it was also a little bit unclear on if he was speaking specifically for Q1 or if he was speaking for the year in its entirety. Tesla still has opportunities throughout the rest of the year to bring costs down, especially as they noted, foreign exchange impact, higher cost of materials, higher logistics costs in the first quarter that hopefully come down a little bit over time. Now that I'm thinking about that though, I probably made the same mistake there thinking sequentially, and Tesla was probably talking year over year on that cost bucket. So we'll go back and think about that a little bit more, but energy we talked about a little bit lower than my expectations, a little bit lower than last quarter despite that growth. So kind of interesting to see that. Maybe just the lower average selling prices driving that, which probably makes sense given the, based on how the previous quarters had come in. My estimate for revenue was 8% too low, but my estimate for deployments was 20% too low. So it tells you, there's obviously an average selling price difference on the lower end that's affecting those two buckets. But total gross margin then, pretty close to what I had forecast with all those factors that we talked about. All right, so operating expenses should be pretty straightforward. I don't think we saw any major surprises on these lines. Just get a handle on that. So R&D did actually decline. So some savings there from an R&D perspective, but still, relatively in that sort of ballpark that we've been seeing, $800 million range. SG&A is 1076. So pretty close to what I had expected. I don't think we saw any Bitcoin or other charges this quarter as expected. So that gets us to our 2664. Yep, operating income. Again, in line with my forecast pretty much, and a little bit lower than analyst expectations. So we do sit at that 11.4% operating margin. Remember last quarter, there was a 16% operating margin. My comment there is a little bit, can't really see it, but 14.9% was the actual operating margin last quarter if we exclude the FSD revenue recognition, which as we now see from this quarter is not something that happens consistently. Tesla obviously earns money from FSD, but it was just a recognition from backed revenue that obviously had not previously been recognized. So all of that lumping into one quarter versus being spread out consistently. So that's why you want to kind of back those things out. And if we look at the same thing for total gross margin, that was 22.7%. Automotive gross margin was 23.1%. So those should really be the comparisons you're looking at when looking at the changes over quarter. So essentially, gross margin, automotive gross margin X credits declined, 410 basis points quarter over quarter. All right, EBITDA, let's take a look. 4267. So nothing too surprising on that. GAAP net income is 2513. I'll do non-GAAP here. 2931. Stock-based comp. Was 418. So keeping that well under control. And I assume 0 for CEO compensation as that plan has now been fully earned and recognized. And then EPS 0.73. Yep. And we'll calculate the PE ratio here in a second. 0.85. So well done, analysts. Again, despite some of the muddiness up top, at the end of the day, shaking out to be in line with consensus. I do think my forecast was a little bit better in general, but that's neither here nor there. Free cash flow is 441. Which I meant to talk about this yesterday. I think I just kind of skipped over this, but I didn't really understand why the free cash flow expectation was so high, given that obviously Tesla grew inventory by 18,000 vehicles. That's going to hurt your free cash flow. So in any quarter where you've got dramatic inventory growth, that's going to kind of be the case. So not sure why that was such a big thing. Obviously foreign exchange impact we talked about, comments on outlook we talked about. All right, so those are the numbers. I'm going to take a look at chat and just see if people have some questions. I think we got like 11,000 people watching, which is exciting. And again, just a reminder, if you are just tuning in, the conference call will be in about an hour, a little bit less, and there will be a link in the description to check that out. We'll do the same thing. I'll do notes as Tesla has the call, and we'll do a little bit of a reaction to their comments following the call. And then I'll just do another shameless plug. If you are appreciating this, I do appreciate the likes on the stream. It's a little bit imbalanced for the normal ratio. I think we're getting a lot of people that are disliking this, so that's okay with me. All right, I'm trying to just kind of look through if there's anything else that's really super important to mention on the financials. It's always a little bit easier, and this is why it's nice to go through ahead of time. It's always a little bit easier when the numbers come in relatively in the same ballpark of what we'd expected. So, there's obviously a couple of swings. I guess let's take a minute to then calculate the average selling price. Take a look at the stock quick before we do that. Down 4.20%. How fitting as I look at that. So that's, it's disappointing. It's a little bit surprising to me. I would have assumed that the whisper number, quote unquote, Winston, again, thank you. Back-to-back super chats from Winston the last couple of days. That means a lot. I appreciate that. But anyway, in terms of this, I would have expected the whisper number to be even a little bit lower just because, we've seen so many things throughout the quarter of Tesla cutting prices, all this concern that's arisen. So I'm a little bit surprised by the reaction here. I was actually a little bit surprised that the stock was as strong as it was today. Obviously, it fell off at the end of the day, but with the price cuts that we just saw last night, I think that's going to play into the reaction to the earnings report as well, of course. So we'll see where things go from here, but it's a little bit surprising. All right, so I want to calculate the ASP. Again, this is going to be impacted by not FSD, but impacted by foreign exchange. So bear with me. This might take me a second because usually I do not calculate this in the summary sheet. I just let it flow through from my more detailed model, which is on Chairloft. So let's take a look here. What I'm going to need is, we'll just go off to the side and do some clean sheet stuff. So I'll need auto revenue, I'll need auto COGS, I'll need reg credits, and I'll need leasing revenue, leasing COGS. I think that should allow us to get everything, X credits and X leasing. So then we've got our standard for comparison. So let's fill those in. We should have a few of these things. Okay, so automotive sales was 18,878. Automotive COGS. $15,422. Reg credits we know is 521. And leasing revenue, it should actually already be backed out of this. So we've got 564 there for leasing revenue. And leasing cost of goods sold, 333. So for those that are not familiar, just what I was talking about there a little bit with the leasing margin. Wow. Why am I blanking on this calculation? This is so embarrassing. So the leasing margin is 41%. So that's what I was talking about, how that drives up the margin and would affect the the costs in the ASP on an average vehicle basis. So that's why we're just kind of taking that out. Obviously, it's earned for the business and it's fine. It's fine to have that business and it's good margin, but it's also interesting to look at the ASPs X leasing, as that gives us a better feel for, you know, the sales, obviously. Because there's more units being leased than the revenue being recognized, it's going to drive ASP down, is sort of the point. All right, so auto revenue, that excludes leasing. So if we put these together, that should give us our 19,422 plus 15,21. Sorry for this, I know it's probably annoying to do that. All right, so auto revenue, that excludes auto COGS, that should exclude. So we should just be looking there, and then I think we can just divide that by our deliveries. Fingers crossed I'm doing all this math correctly. I'll let you guys know if I'm not. It's possible I'm not. Obviously, this needs to be multiplied to make it work. But it looks like it could be $45,000 average selling price. Just trying to think if that's realistic. Oh no, I lost my spot. Again, I know this is super interesting. Watching me struggle with math. Usually this is not the way I get to this number, but I'm gonna assume these are correct. We'll put them in and see what that does. A couple more on there. See how that looks. I definitely want to double check these, and if anyone in the comments wants to double check me as well, that would be awesome. Throw like a 1 cent super chat on there if you can or something. Take out lease deliveries. Yes, awesome. Thank you, JMO. Genius. All right, so ignore those. So we've got, I used all the deliveries there for the calculation. Again, my sheet normally takes those out, but so let's take the leasing deliveries out. Great call. I did forewarn that I might struggle with this during the live stream. Obviously, I'm capable of figuring it out, but it just takes a second. So let's see, leasing deliveries, 22,357. So we'll put that down there. We'll go back here. Ba-ba. And we'll subtract that. There we go. That seems more correct. JMO coming through. All right. That looks better. It also makes more sense with my estimates. So I was a little bit high on my ASP estimate, my cost estimate actually right on. So makes sense. The foreign exchange impact, if you've got 800 million, I kind of just want to see what the ASP would be excluding that. So we should just be able to take that and add 800. As long as I'm interpreting Tesla correctly. So that could drive it up to 49,000. So it's like a couple thousand per vehicle, potentially, in terms of that foreign exchange impact. I hope Tesla talks a little bit more about that. I'm going to try to do a little bit more research on this. I tried to do more on it last quarter and it just fell off the plate, but obviously it's a significant driver here, so something I need to spend a little bit more time figuring out. But yeah, I mean, it's nice to see the costs start to come down a little bit. Still up 5% year over year, obviously, but down, you know, whatever percent that is, but down $1,000 quarter over quarter. And then the ASP, it is still staying above the $47,000 level, just by a hair, but still above that level, even with the foreign exchange impact. So good to see that. Again, the margin X leasing probably around that 18% level, so potentially a little bit lower than what Tesla had originally expected when they communicated the guidance on the Q4 call, but with the caveat there that they may have just been guiding for the year, so we don't know that for sure. Okay, now I think we can get into the chat and try to go back and see if people have any questions. Sorry if this chat seems like kind of out of control, so that's disappointing. I'm gonna go ahead and ban that guy that keeps saying Ponzi. Seems people are frustrated with that. Okay. Yeah, for whatever reason, this seems to have attracted more Tesla Q types than usual. All right, just going back, seeing some of these super chats. 40 watt, appreciate that. Unfortunately, the UI that I've got for this is not the smoothest, so it's somewhat difficult for me to see those come through. John, appreciate that. All the support means a lot. Mike, thank you. Evo, thank you. Julian, thank you. Potentially see you in Austin. I will probably go down regardless of invite or not to for the shareholder meeting. We'll see on that. Again, if you're just kind of hanging out or you tuned in late, obviously you can go back through the recap here, but the conference call will start in about 45 minutes and there will be a link for that down in the description. And I would encourage people to hop over there once we wrap up here, probably pretty shortly. So I'm not seeing too many questions. Winston, again, thank you. Appreciate that. All right, well, I'm not actually seeing too many questions. I'm not seeing any major errors now that we do have the regulatory credits broken out. I guess sort of the one of the unanswered questions, it would be the item that we talked about going into the stream today. We don't necessarily know what the impact from the Inflation Reduction Act would be. Sorry, I just got distracted by the chat there. We don't actually know what the impact of the Inflation Reduction Act battery production credits is. That was not broken out that I saw in the letter. So that may be just something that is contributing potentially to the ASP if Tesla is kind of throwing that as automotive revenue. I'm not sure that that's where they would put it, but I guess I'm not sure exactly where else it would fall. If it's not in there, maybe they're just putting it into regulatory credits. And maybe that's one of the reasons that this came in a little bit higher. You know, maybe you see like the 300 million from sort of the normal regulatory credits that we get from Tesla selling credits to other automakers. And then maybe there's another couple $100 million there from the battery production credits. That'd be a clean way to do it. So hopefully that's kind of how it's structured, if that is the case. But, you know, maybe Tesla will talk a little bit more about that on the call. So I'll wrap this up pretty soon. Geekaholic, thank you. David Osborne, appreciate that. Jordan, thank you. Change agent, got your Giga Berlin, got your Giga beer in Berlin on ice. Honestly, I got to get over to Europe. It's been too long. Okay, guys, I think we're gonna wrap it up here. But again, tune in to the earnings call. That'll be in about 40 minutes, and the link for that will be down in the description. Bernard, thank you. So we'll go through that, and then we'll see what Tesla's got to say, and if that gives us any new context here. But just, I guess, to give sort of an overall thought here, I'm not disappointed with this earnings. I think it's actually pretty decent. Obviously, the gross margin was a little bit below my expectations, so if there's anything in there that's maybe a little bit more disappointing, it would be that. But it seems like that's really driven from foreign exchange impact. So if Tesla gets a foreign exchange tailwind, or if they had happened to this quarter, you know, that could have made the quarter look really strong relative to expectations. So I don't want to, you know, over focus on just one quarter gross margin. I think what's clear is that Tesla still has plenty of room to maneuver here with these 19% gross margins overall. It's really exciting that the energy business is growing so fast. Hopefully that'll continue throughout the rest of this year. And we can see Tesla put up, you know, 15, 20 gigawatt hours, maybe even more than that for this year in terms of energy storage deployed. And that's going to start contributing even more significantly to the operating profits, as obviously we've talked about Tesla is able to leverage their entire business to keep fixed costs for the energy business down, which means that the energy gross margin can kind of just flow through to operating margin, which even though 11% gross margin for, if this were a standalone business would not be great. That's not a super strong business unless you're massive scale. With Tesla scale provided by the auto business, that actually can be pretty healthy. And it's, we're still very early in that ramp. So it's kind of exciting to see that. And, that $168 million that generates, that goes into operating profit just the same as it would if it came from automotive. So hopefully that grows and becomes an even more significant factor as, over the last 4 quarters now, it's $500 million in profit. And again, just at very early stage in the ramp. So exciting to see that for Tesla Energy. I know I did mention that we'd calculate the PE and then I forgot about that. So let's just do that quick. It looks like we're around $3.40 over the last 4 quarters now. So that would be a decline from around $3.63 previously. So obviously earnings per share down year over year as expected. But $3.40, we're at $173, I think is the last I saw after hours. So the price to earnings ratio right now is 51x versus that's kind of where we had started, I think the day or maybe earlier this week. So it doesn't change the PE too much. Hopefully, during this period of time, there's going to be a little bit more emphasis on price to sales ratios because obviously revenue here still growing healthy, 25% year over year. So, 86 billion in trailing 12-month revenue versus 81 prior to this report. So the price to sales ratio obviously declining, even though the PE ratio is increasing as earnings drop here for a little bit. All right, so that'll wrap it up. Again, make sure to tune in a little bit later on for the earnings call. That will be down in the description. We'll hop over there, and it hopefully should take you there right after we wrap up here. So we'll see you in a little bit. Thank you.